Hey guys, welcome back to the channel. In this video, we are going to talk about AT&T, ticker symbol T. Okay, and this has been brought up several times on my channel by someone, and I want to give them a shout out because I think they may have found a pretty good buy here, in my opinion. So I want to go over this article in the Motley Fool. We're going to break down the charts and just kind of want to bring this to your attention as another option for those of you who are looking for kind of more of a safer play. To maybe create some extra income. So it says AT&T can be a bond-like income tool for retirees. It's been a tough stretch for retirees in the age of low yields where bonds and savings accounts pay almost no interest. Dividend stocks have been a natural alternative, often offering the highest yields but are riskier, which can be troubling for investors who want to generate income without the risk of losing money. Telecom company AT&T stands out as a stock that can check many of these boxes for retirees. While no stock is risk-free and AT&T happens to be down 25% over the past year, I think that AT&T represents a solid option for income-craving retirees right now. A very stable business model. Just about anyone with a cell phone in the United States knows that AT&T is a company and what AT&T is and what the company does. It's one of the three major U.S. wireless networks along with Verizon and T-Mobile. Today, more than ever, communications are almost as crucial as to households as electricity and water. About 97% of Americans own a cell phone and often use it to replace landlines or connect to the internet where wired internet service is hard to come by. The phone bill ranks high in terms of importance in most consumers' monthly budgets, so AT&T's business has proven very stable over the past several years, and will way past this point. People tend to pay their cell phone bills through the economic conditions during good times and bad. People lost homes they couldn't afford during the financial crisis in 08-09, one of the worst economic crises since the Great Depression. Still, AT&T saw virtually no drop-off in its business. This kind of sales stability is a welcome sign for retirees. The dividend is remarkable. A 10-year bond from the U.S. government pays about 1.5%. while inflation in the U.S. hits 6% this year. Fortunately, AT&T's dividend yield is a whopping 9%, enough to outpace even the high inflation we have seen this year. A common rule of thumb is that very high dividend yields can be a red flag for investors, a sign that investors are not confident in a company, so they sell its stock, which increases the dividend yield. We want to focus on whether AT&T can afford this payout using the money that its business generates instead of borrowing to pay that dividend. In the chart here, I'm going to link this in the description below, but it says we can see that AT&T has steady growth in its free cash flow over the past decade, and the dividend payout ratio remains manageable at 58%. In other words, AT&T is spending 58% of its cash flow on the dividend, and its business would need to dramatically decline for it not to afford that payment. But we've already seen how durable AT&T's business is, so it's probably fair to say that it isn't likely that the dividend would drop off. Instead, the company has raised its dividend for the past 36 years in a row. Holy moly. It's important to note that AT&T has a pending deal to spin off of its entertainment assets as a new company. The deal will result in a lower payout, so AT&T's dividend yield will probably not remain at 9% once the spinoff closes. We'll revisit that in a moment. And this is why is AT&T down so much? AT&T has had a rough year over the past 12 months, down 25%. One potential reason is that the company's debt-heavy balance sheet. It has two massive mergers, DirecTV and Time Warner. So both, DirecTV was $48.5 billion. And then Time Warner, $85.4 billion. These deals left AT&T with a colossal mountain of long-term debt totaling $155 billion today. All of this debt creates interest expense, and with the potential for rising rates, the market could be afraid that AT&T's debt will continue to cost more in interest payments. Addressing the issue, AT&T has admitted the failure of its entertainment business. It sold DirecTV over the summer for less than it paid for it. The rest of the entertainment business, mainly the media assets like HBO and Warner Brothers, is being spun off of a new company in a deal with Discovery. The benefit of this deal for AT&T shareholders is that the company will be unloading $43 billion in debt when it closes the deal, a little more than a quarter of AT&T's total debt load. It will go a long way in freeing up more financial breathing room. Management is projecting that as it continues to pay down the debt, the company hits its long-term debt target in about 24 months. This includes reducing the dividend payout ratio, another way of saying they will cut back the dividend to free up more cash for paying down the debt. But with such a sizable existing yield, investors should still receive a generous dividend from what will be even a more financially sound company. So very interesting. So that currently at 9%, and as the stock price rises, that dividend yield will probably go down. However, if you have the low stock price, kind of a win-win in my opinion at this point, because you have a low stock price and you can come buy in and get a lot of shares, and you have a high dividend yield of 9%. And then as, let's say, the dividend yield drops down, well, that means probably the stock price is going to rise. So you're going to have some capital gains on the stock price in general, but you still may have your dividend yield as well. So you're still going to make more money in the long term. So that's pretty neat. So let's go ahead and take a look at the charts and let's see what they're telling us. All right, guys, looking at AT&T, ticker symbol T. All right. And right now, currently, we're basically pretty much at the bottom of the fib level, which is where I like to come in and try to start buying some of these things, because you just have a lot of room for growth right here. Okay, so currently it's trading at about $22 and some change, $22.84 currently at 6:31 on December 13th Central Standard Time. The high of this 180-day time frame was $33.97. Current low is $22.20, which we have potential to possibly poke our head right back down there. We're currently trading underneath the red SMA line, and you need to get about $25 and hold to confirm a reversal and move to the upside. But current floor $22.20. Can it go lower than that? Absolutely. But currently that's the floor, and your first level up is about $24.75 and $26.70. $28, $31, and about $34 is the absolute ceiling on this time frame. So for me, if I start buying in, I'll probably just start maybe accumulating a few shares here and there, especially if it stays at these levels here, and just hold. And this can be more of a longer term investment. And kind of crazy, I never even thought about this because I use AT&T, and it's kind of obvious, like what the article said, everyone has a cell phone, and you're going to pay your bill. 99% of people probably have everything just automatic drafted. It's a necessity now. It's no longer a something that I have a cell phone and I'll use it every now and again. It's an absolute necessity. Texting, calling, email, all that stuff. I mean, it's something that people use in their everyday lives. So this is one to keep an eye on, guys. And if you're searching for some type of good dividend stock, I think that this might be one that you want to consider and keep an eye on. So anyway, a big shout out to our follower, subscriber, who has mentioned this twice to me already, or maybe 3 times in our comment section on other videos. So I appreciate you doing that and bringing it to our attention. And everybody else, if you have a stock that you'd like me to do some research on and cover, feel free to comment below, and we'll knock that out for you as well. Other than that, we'll catch you in the next one.